World Development Report 2014. Risk and Opportunity. Reforming Social Insurance with Santiago Levy, Vice President for Sectors and Knowledge, Inter-American Development Bank.
Hello, I am very pleased to be here to speak about the issues of social insurance in developing countries. This is a major component of social policy and is very relevant in very many dimensions. It is the central mechanism by which countries provide insurance to workers and households against fundamental risks like ill health, like loss of employment, like disability, sudden death, or other types of issues that might really hurt the household welfare. The central issue with social insurance in developing countries is that in most places it is associated with the employment status of the workers. What we call formal workers have social insurance paid by themselves and by the firms that employ them, and sometimes we call this contributory social insurance. The rest of workers in the informal sector either have no formal mechanisms for social insurance, or lately, in many countries, they have access now to a disjointed set of health and pension programs. This mechanism of having part of the labor force provided social insurance through contributions made on firms and workers in the formal sector, and the rest of the workers having social insurance provided from general revenues from the government, is not a very good mechanism to protect workers against risks. To think about this, first consider that it is very likely that during a worker's lifetime, he will continuously move from formal status to informal status. Data from many countries shows that the idea that a worker joins a firm and stays working with that firm for the rest of his lifetime is actually a very unlikely scenario. Most panel data shows that workers transit between employment either between formal firm and another formal firm, or equally likely between formal employment and informal employment. What this means for social insurance is that sometimes workers are covered by the formal system of contributory social insurance, and sometimes they are either not covered at all or they're covered by a disjointed set of programs. It also implies, from the point of view of pensions, that the system is actually very incomplete. If you only contribute to your pension when you're in formal employment, then you will only save for your retirement part of your working life, not the full amount of your working life. This is a very difficult problem to solve because historically, in most developed countries, social insurance was indeed associated with the condition of employment. In those countries, salaried employment is a very large component of the labor force, and by and large, this mechanism of social insurance works. But in most developing countries, salaried employment, and in particular formal employment, is in most cases less than 50% of the labor force. As a result, this is a very inefficient mechanism in providing social insurance for households, and in fact, you have a situation in which either a large segment of the labor force is completely unprotected from risks, or the protection that they face is erratic depending on whether they're formal or the informal sector. In many countries, particularly in Latin America, governments have responded to this situation by creating a set of parallel programs to protect workers when they're informally employed. Sometimes people use the expression of non-contributory social insurance to reflect the fact that this social insurance is not being contributed from wages by workers in the formal sector, but is actually being paid from general revenues from the national treasury. There are some advantages to this system because at least informal workers will get some protection, but there are also some important disadvantages. Because if you now provide the same worker with a mechanism for social insurance if he has one type of employment, but a slightly different mechanism for social insurance when he's in a different type of employment, you run the risk of creating situations in which workers and firms will arbitrage between one system and the other, i.e., they will try to change the form of employment to take advantage of the fact that in one case social insurance from the point of view of the worker and the firm is free, and in other cases social insurance from the point of view of the worker and the firm must be paid by themselves. These arbitrage situations in which workers and firms change their behavior can actually hurt productivity. Firms might decide to stay small to avoid social security contributions, and workers might decide to avoid salaried employment to also not pay Social Security contributions, particularly if they can access other social insurance programs that are provided from general revenues. But by doing so, the amount of self-employment in the economy is much larger than what it would otherwise be, and in many cases, firms might stay smaller than what they would otherwise be, precisely to avoid being caught and having to pay these contributions. Excess self-employment and very many firms that are small begins to reflect part of the large informal sectors that we see in many developing countries, and is one reason why productivity in these countries doesn't grow as fast as it could. In small firms, economies of scale are not fully exploited. There's no innovation. There's sometimes very little worker training. But also in self-employment, workers are very much by themselves without access to labor training programs and to mechanisms to increase their welfare over time. Where we stand today is that in most developing countries, we have yet to create a really universal, efficient system of social insurance that covers all workers regardless of whether they're in one form of employment or another form of employment. Ideally, what we would like to do is to cover workers against all risks that are common to the same form of employment. It doesn't really matter whether you're self-employed or salary employed, you still run the risk of being ill, and therefore you should have the same coverage with the same mechanism regardless of what your job is. And the same is true if workers don't save for their pension, they should be saving for their pension regardless of whether they're in salaried employment or in self-employment. A big important issue for discussion towards the future is trying to construct mechanisms to consolidate and unify the very disjointed systems of social insurance that we have in developing countries towards more universal systems that are funded from the same sources of revenues, that are more efficient in protecting workers against risks, that are more equitable, and at the same time do not hurt productivity as many of the current arrangements do. This is a big job and a big discussion ahead. Thank you.